Fresh data released by the U.S. Department of Labor on August 1 shows that the labor market is clearly losing momentum. In the 3 months ending in July, the average number of new jobs added was only about 35,000 per month, a sharp drop from the 128,000 jobs recorded in the previous 3 months. This is not merely a slowdown, it's a signal that the health of the U.S. economy is facing significant headwinds. As job growth stalls, household income will be affected, which in turn threatens consumer spending, the main driver of U.S. GDP, with deceleration. Earlier, GDP data from the U.S. Department of Commerce painted an equally grim picture. Annualized growth averaged just 1.2% in the first half of 2025, far below last year's 2.8%. This sluggish pace comes at a time when the U.S. is maintaining high interest rates, making capital more expensive and putting increasing pressure on businesses. When GDP and employment both lose steam, the market naturally begins to worry about the risk of recession. Experts interviewed by ABC News are split into two camps. One warns that recession risks are rising, while the other says it's still too soon to draw that conclusion. Professor Harry Halzer of Georgetown University noted that the likelihood of a recession has increased, but this could simply be a temporary adjustment. This is a cautious stance, given that a recession is often defined as 2 consecutive quarters of GDP decline, in the simplified sense, or, per the NBR, a significant and widespread drop in economic activity across multiple indicators lasting several months. By this definition, the U.S. economy has not yet met the criteria for a recession. However, Mark Zandi, chief economist at Moody's Analytics, believes the current situation is more than just short-term volatility. He attributes much of the problem to President Donald Trump's tariff policies, arguing that these measures raise import costs, push up prices, and erode business competitiveness. This has a sound macroeconomic basis. When businesses face higher costs, they cut back on investment, hiring, and even production, thereby restraining growth. President Trump's immediate dismissal of Bureau of Labor Statistics Commissioner Erica McIntyre following the jobs report also drew attention. It reflects the political sensitivity surrounding economic data amid heated debates over the direction of the U.S. economy. In the long term, political interference in statistical agencies could undermine market confidence in the transparency and reliability of the data. That said, the U.S. economy still has bright spots. Mass layoffs have not occurred. Personal consumption, which accounts for about 2/3 of GDP, continued to grow in Q2, and corporate profits have remained solid. These factors help prevent the U.S. from falling straight into a recessionary spiral. Moreover, history shows that recession forecasting is notoriously difficult. In 2021, many warnings followed the surge in inflation and the Fed's rate hikes, but no recession materialized. More recently, predictions of a downturn after Trump's new tariff plans have also been walked back. Economist Claudia Sahm emphasized an important point: recessions often occur when a shock undermines confidence, prompting businesses and consumers to change their behavior in a negative way. This is inherently hard to predict. However, she also warns that a slow-growing economy is not a healthy one. Merely avoiding a recession is not a sufficient goal. The U.S. should aim for sustainable and inclusive growth. From a macroeconomic perspective, the U.S. is currently in a sensitive phase. Weakening jobs and GDP data, combined with the negative effects of tariffs and high interest rates, are increasing the risk of a recession in the second half of 2025. However, the resilience of the labor market, consumer spending, and corporate profits suggests that a soft landing is still possible, provided that monetary and trade policies are adjusted in time.